Thanks for clicking. Canada's mortgages will continue to be stress tested for the foreseeable future. This was the message coming down from the Office of the Superintendent of Financial Institutions, or OSFI, Canada's banking regulator. The mortgage stress test, if you'll remember, mandates that borrowers qualify based off paying 5.25% interest rate or 2 points above their contract rate, the rate they actually pay, whichever is greater. The head of OSFI, Peter Routledge, said that while the uncertainty and anxiety of rising interest rates have caused some Canadians to advocate for a loosening of the stress test, OSFI would not be loosening its standards anytime soon. Some Canadians are advocating.
Oh, wonder who that could be!
Indeed, the calls for the loosening of these requirements comes as OSFI is instructing the banks to increase their capital buffers, the amount of money they hold on hand, and we've also received recent news of Canada's mortgage insurers gearing up for increased stress in the system. As we'll see, these are not signs of a system looking to reinflate. Rather, these are signs of a system that is engaging in damage control. So what I want to do today is go over OSFI's decision to maintain the current mortgage stress test and what OSFI looks for in the future, take a look at some of the decisions being made by Canada's mortgage insurers, and then discuss some implications for the future. It's midway through the month, so Canada's national real estate data should be out any day now, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into OSFI. As mentioned, OSFI stated very specifically that it has no intention of loosening the stress test anytime soon, despite increasing criticism that it puts an undue burden on homebuyers. In a statement, Routledge said that OSFI sees great risk in speculating on mortgage rates, and that OSFI does not consider the minimum qualifying rate to be a tool to manage the demand for housing. So the mortgage stress test, according to OSFI, is a tool designed to mitigate risk, both for the banks and for the home buyers. It's not a tool designed to produce housing demand. It's not a tool to be raised or lowered to stimulate the housing market. And this isn't the first time in recent memory that OSFI has rebuked pleas from some Canadians to lower the stress test. As in September, when the policy rate was 100 basis points less than it was right now, the real estate boards were pleading with OSFI to lower the stress test and re-stimulate demand.
What did I tell you? What did I tell you? What did I tell you?
But as recent announcements from OSFI has shown, this isn't a regulator that is concerned with reinflating the housing market. This is a regulator concerned with damage control. As mentioned earlier, OSFI also announced last week that it was increasing the capital requirements that it imposes on the big banks, amid rising interest rate costs and high household debt. Very basically, Canada's biggest banks now have to hold more money on hand to protect themselves and the rest of us against potential losses. So if the citizens of Bailey Park stop paying their bills, the building and loan doesn't take down the entire system. In a statement, OSFI said that it ensures banks build up safety buffers to protect the financial system when hard times arrive. And the increased requirements reflect OSFI's observation that high levels of systemic vulnerabilities have persisted and, in some cases, increased in recent quarters. And the new regulations coming down from OSFI comes as the banks are reporting a major increase in loan loss provisions, as the banks themselves prepare for the defaults that are coming amid the impending recession. So on the one hand, you have the banks preparing to lose a lot of money. You have the regulator telling the banks they have to be prepared to lose a lot of money. And then you have some Canadians asking that the banks lend out more money, more risky money, and that the mortgage stress test be repealed.
Tell me, what color is the sky in your world?
And it's not just OSFI seeing this potential stress in the system. Some Canadian mortgage insurers are seeing the stress and trying to head off problems early. Last month, one of Canada's private mortgage insurers, Sagan, formerly Genworth Financial, announced that it was allowing homeowners to extend their amortizations up to 40 years if they can demonstrate financial hardship. And this isn't just for holders of variable rate mortgages with trigger points that we've talked so often about on this channel. This is also for holders of fixed rate mortgages. So if you had a mortgage in the past 5 years at say 3.5%, you go to renew and the rate is now 5.2, 5.5%, and you can demonstrate financial hardship, Sagan will allow you to re-amortize up to 40 years. And while this will certainly be welcome news to holders of these fixed rate mortgages that they won't have to sell their home due to not being able to make the payments, it does demonstrate an insurer that is growing increasingly worried about the state of Canada's housing market. CMHC banned 40-year mortgages back in 2008. at least in part because of the financial vulnerability that they can produce. If you take a $500,000 mortgage out on a 40-year amortization, at the end of that 5 years, you've paid a little over $120,000 in interest, and you've only paid down your house by about $23,000. This obviously leaves the homeowner extremely vulnerable to major swings in the market. If you're only paying down your home by $23,000 in that first 5 years, it very well could be that you are underwater if the housing market swings even minutely. If the housing market goes down by, say, 10%,
no way, never happened.
Your home is now worth $450,000 and you owe $477,000 on that home. So 40-year amortizations mean that the home is not paid down very quickly and obviously adds a lot of vulnerability to the everyday home buyer. But the banks and the insurers don't want to see a major flood of new housing coming onto the market. A flood of new supply onto the market without an increase in demand will lead to lower prices. So the banks also and the insurers don't want to be underwater. They don't want those homes worth less than that which is owed on them, as that could induce a very real problem in the banking system. So these insurers are trying to head that off. They don't want to see a flood of defaults, a flood of forced sellings, because once we see that, then the problem has moved from the everyday homebuyer into the banking system itself. And that's something, as we saw in 2008, everyone wants to avoid. So between OSFI reiterating its stance on the stress test and instructing the banks to ensure it has adequate capital to prepare for the losses coming in 2023, and between the mortgage insurers allowing Canadians to go into risky 40-year amortizations, this is a system that is not looking to reinflate the housing market. This is a system that is looking to 2023 and is trying to prepare itself. The system isn't trying to reinflate just yet. The system is trying to protect itself from what's coming in 2023, from the impending recession, from the effects of these higher interest rates that we've seen throughout 2022. With all that said, we will continue to track how that system fares in 2023 on this channel. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.